Ethan buys a rental property. Lucas puts the same money into the stock market. Both think they made the smarter move. Both are wrong, because one is counting what's visible and the other is ignoring what's invisible. And when you actually run the real numbers over 20 years, the difference isn't just money, it's how they lived their lives. Ethan and Lucas are 28, same salary, same ambition, same starting line. They both have $60,000 saved. They both earn $80,000 a year. No debt, no shortcuts, just two different beliefs about money. Ethan wants control, something physical, something he can touch. So he puts $60,000 down on a $300,000 rental property. Lucas wants freedom, flexibility. So he puts his $60,000 into index funds and commits to investing every single month. Same money, same time, completely different mindset. At first, Ethan feels like he cracked the code. He owns property. He gets rent. People around him start treating him differently. It feels real. It feels like progress you can point to. Lucas doesn't feel that. His money lives on a screen. Some days it's up, some days it's down. No tenants, no keys, no proof, just patience. Ethan feels ahead. Lucas feels like he's waiting. Then the real game begins. Ethan's property brings in $2,000 a month in rent. It sounds like passive income. It sounds like freedom, but the mortgage is $1,400. Property tax is $300. Insurance is $150. Maintenance averages $250. Suddenly, that $2,000 isn't profit. It's barely breaking even. And that's in a good month. One broken AC, one bad tenant, one empty month, and everything shifts. Lucas doesn't deal with any of that. He just keeps investing, $500 every month. No calls, no emergencies, no surprises, just consistency. It feels boring, almost too simple. But that's the point, because simple things scale better over time. Now here's where things start to tilt. Ethan has leverage. He controls a $300,000 asset with just $60,000. That's powerful. If the property grows at 3% a year, that's about $9,000 in appreciation annually. On paper, Ethan looks like he's winning big. His net worth grows faster than it feels. Lucas, on the other hand, is averaging around 8% in the market. His $60,000 becomes roughly $130,000 in 10 years. Respectable, but not flashy. Ethan's property? Now worth close to $400,000 after a decade. Equity builds through appreciation and mortgage paydown. The numbers look impressive. This is the moment where most people stop thinking. They see the bigger number and assume the answer is obvious. Real estate wins. End of story. But that's only half the story. Because Ethan didn't just invest money. He invested effort, time, attention. Over 10 years, things go wrong. Tenants move out. Repairs show up at the worst time. Let's say those hidden costs average just $3,000 a year. That's $30,000 gone. Quietly, no headlines, no celebration, just money leaking out. And then there's time. Even if Ethan spends just 5 hours a month managing the property, dealing with issues, coordinating repairs, that's 60 hours a year. Over 10 years, that's 600 hours. That's 25 full days of his life, not relaxing, not building something new, just maintaining what he already owns. Lucas? He doesn't notice time passing in the same way. His investments run in the background. He doesn't think about them daily. He doesn't manage them actively. He just sticks to the plan. And because of that, something interesting happens. Compounding starts to take over. After 10 years, Lucas hasn't just grown his initial $60,000. He's added $500 every single month. That's another $60,000 invested over the decade. With compounding, his portfolio isn't sitting at $130,000 anymore. It's closer to $220,000. Quietly, without stress, without effort. Now the twist hits. Ethan's total equity after 10 years after appreciation and mortgage paydown might land somewhere around $160,000 to $180,000 depending on the market. Lucas is sitting at around $220,000. Suddenly, the gap isn't what people expected. In fact, in many cases, Lucas is ahead. And that's uncomfortable because it challenges the story people love to believe, that owning property automatically makes you richer, that tangible assets always win. But reality doesn't care about stories, it only cares about math. Now fast forward another 10 years. This is where small differences become massive. Ethan's property continues to grow. At 3% annually, that $300,000 property is now worth around $540,000 after 20 years. The mortgage is mostly paid off. On paper, it looks like a huge win, $500,000 tied to one decision. But zoom in. Over 20 years, maintenance doesn't stop. Repairs don't stop. Taxes don't stop. Vacancies don't magically disappear. Even conservatively, those hidden costs can total $100,000 to $150,000 over 2 decades, and that's assuming nothing goes seriously wrong. And then there's the invisible cost, the mental weight, the responsibility, the fact that Ethan's income is tied to other people, tenants, markets, local conditions. His investment isn't just an asset, it's a system he has to manage. Lucas lives a different reality. He keeps investing $500 every month. No interruptions, no second guessing. Over 20 years, that consistency turns into something powerful. At an average 8% return, those monthly investments alone grow to around $300,000. Add his initial investment growth, and now he's sitting at $600,000 or more. And here's the key difference. Lucas can access his money anytime. He can sell in seconds. He can adjust his strategy. He's not locked in. His wealth is liquid, flexible, quietly working for him. Ethan's wealth is tied up. It's real, but it's not flexible. To access it, he has to sell, or refinance, or take on more complexity. His wealth exists, but it comes with friction. Now step back from the numbers. Because this isn't just about money, it's about lifestyle. Ethan built something tangible, something people can see, but it required attention. It demanded involvement. It asked for his time again and again. Lucas built something invisible. No one sees it, no one praises it, but it gave him something else. Space, time, mental clarity. His investment didn't interrupt his life, it supported it. So who actually made more money? The answer depends on what you measure. Net worth? They're closer than most people think. Effort? Completely different. Stress? Not even comparable. Flexibility? One clearly wins. And that's where most people get it wrong. They ask which investment is better, real estate or stocks? But that's the wrong question. Because both work. Both can build wealth. The real question is deeper. What kind of life do you want while you're building that wealth? Do you want to be involved or hands-off? Do you want control or flexibility? Do you want something you manage or something that runs without you? Because in the end, the smartest investment isn't the one with the biggest number. It's the one you can stick with for 20 years without burning out. So if you had to choose right now, same money, same starting point, same timeline, would you rather build wealth by actively managing it every step of the way, or let it quietly compound in the background while you live your life?